In 1929, 6 months before the big crash, Joseph Kennedy made 3 specific moves. He converted his assets to cash, he bought gold, and he positioned for volatility. When the market plummeted 89%, Kennedy walked away with $50 million while nearly everyone else lost everything. Fast forward to 1987. Paul Tudor Jones made the same 3 trades: cash, gold, and volatility. On October 19th, when the market dropped 22.6% in a single day, Jones made $100 million in one day. Then came 2008. Michael Burry, John Paulson, and others made those same 3 trades: cash, gold, and volatility. They made billions while the global financial system teetered on the brink of collapse. And right now, in 2025, legendary investors like Warren Buffett, Ray Dalio, and Bill Ackman are making the exact same 3 trades. Not 2 trades, not 5 trades. 3. The same 3 that have proven successful before every major crash in the last century. This isn't about random strategies. This isn't luck. It's a mechanical pattern that repeats itself because market crashes follow a predictable sequence. Extreme valuations, excessive leverage, a triggering event, forced selling, and finally, panic. The investors who see this coming make the same 3 trades every single time. Today, I'm going to show you exactly what these 3 trades are, how they played out in 1929, 1987, and 2008, and why they seem to be happening again right now, in 2025. Understanding this pattern gives you a choice. You can ignore it and hold on through a potential crash like most people do, risking losses of 30 to 50% or even more. Or you can recognize where we might be in the cycle and position yourself accordingly. The 3 trades have been made. The pattern seems to be repeating. Let me explain why these 3 trades are so specific. Why not 4? Why not 10 different strategies? It's because crashes follow a predictable, mechanical sequence. And these 3 trades address each phase of that sequence. The first phase is the recognition phase. This is when smart money realizes that market valuations have become unsustainable. The risk now outweighs the potential reward. This is when you exit, convert your positions to cash, preserve your capital, and get out before the real trouble starts. The second phase is the wealth preservation phase. While you're sitting in cash, you're exposed to inflation and currency devaluation. So, you hold gold or other hard assets that maintain their purchasing power when currencies and financial assets start to fall. The third phase is the profit phase. You don't just preserve your wealth, you can actually profit from the collapse itself. This requires volatility instruments, things like short positions, put options, or credit default swaps bets that pay off when markets crash. These 3 trades, when executed together, create a powerful defensive and offensive position. Trade 1 protects you from losses. Trade 2 protects you from inflation and currency risk. And trade 3 can make you money from the crash itself. Then, after all 3 trades pay off, there is an unspoken 4th trade that I'll get to later, buying at the bottom, with the cash you preserved and the profits you made. But first, let us see how these 3 trades have played out across for different crashes spanning nearly 100 years. Trade number 1 is the cash conversion. This first move in the playbook is deceptively simple: get out. But the timing is everything. Smart money doesn't wait for confirmation. They don't wait for the headlines or for analysts to downgrade stocks. The exit happens quietly, methodically, often 12 to 18 months before the market even realizes anything is wrong. This is the invisible phase where fortunes are either preserved or wiped out. Let's rewind to the Roaring '20s. Joseph Kennedy was no cautious investor. He was a gambler, a speculator who manipulated stock prices for sport. By 1929, he had stakes in dozens of companies. The market had tripled. Speculation was a national pastime. People were borrowing 90 cents on every dollar just to buy more stocks. But Kennedy saw what everyone else was ignoring. When everyone is already in the market, there's nobody left to buy. And without new buyers, even a small dip can trigger a disaster. So, in the summer of 1929, Kennedy did something radical. He started selling. Not all at once, because that would have tanked his own positions. He did it slowly, quietly. A few shares here, a block of shares there. By September, he had converted most of his portfolio to cash. The market peaked on September 3rd. Just 7 weeks later, Black Thursday arrived. While the nation watched their life savings evaporate, Kennedy was sitting comfortably in cash. Insulated, calm, and ready. Now, let's fast forward to 1987. Paul Tudor Jones was running a successful hedge fund, but by the middle of the year, He was feeling deeply uneasy. The Dow had more than doubled in 5 years. Price-to-earnings ratios looked stretched. Margin debt was climbing. And there was a new wild card in the game: program trading. Computers were executing massive, automatic trades, creating feedback loops that nobody fully understood. Jones ran the numbers and concluded a crash was inevitable within months. He didn't mince his words. In August, he started reducing his long positions. By early September, he had raised a substantial amount of cash. He even wrote to his investors, telling them to expect a major crash by October. The market peaked on October 2nd. 17 days later, it collapsed. Jones was already out. Now, let's look at 2008. Michael Burry saw the housing bubble years before it burst. By 2005, he had stopped investing in stocks entirely. He raised cash and simply sat on it, waiting. John Paulson came to the same conclusion in 2006. He launched a fund dedicated entirely to betting against the housing market. That required raising massive amounts of capital from investors. And Warren Buffett, always the conservative, had been accumulating cash since 2006. By 2007, Berkshire Hathaway was holding over $60 billion. The message was clear: there was nothing worth buying at those prices. The market topped in October 2007. The financial system collapsed throughout 2008. The investors who had converted to cash were protected. Everyone else got crushed. And that brings us to today, 2025. Warren Buffett is sitting on a staggering $325 billion in cash. Let that number sink in. It's the largest corporate cash position in history, not just in absolute terms, but as a percentage of total assets. Buffett has been systematically selling off positions. He cut his Apple stake in half. He's been selling Bank of America shares every month. He's not buying anything. In his latest shareholder letter, he said it plainly: he can't find anything attractively priced. The translation? Everything is overvalued. Time to exit. But it's not just Buffett. Jeff Bezos has dumped over $13 billion in Amazon stock. Mark Zuckerberg has sold billions in Meta shares, even as the stock hits all-time highs. Jamie Dimon, the CEO of Morgan Chase, sold stock for the first time in his entire tenure. Insider selling across corporate America is at levels not seen since the peak of 2007. These aren't retail investors panicking. These are the people who run the companies. They see the real numbers. They see the real customer behavior. They see the real cracks forming in the foundation. And they are converting to cash. Trade 1 is happening right now. The smart money is quietly heading for the exits. It's the exact same pattern as 1929, 1987, and 2008. 12 to 18 months before the collapse, the insiders disappear. Once you're sitting in cash, you face a different problem: erosion. Cash doesn't protect you from inflation. It doesn't shield you from currency devaluation. And when governments respond to crises by printing unlimited amounts of money, holding dollars becomes a slow bleed. That's where trade comes in: gold. Bernard Baruch was one of the shrewdest investors of the early 20th century. He made fortunes in previous panics by spotting bubbles early and positioning himself accordingly. In 1929, Baruch didn't just exit to cash. He moved a substantial amount of his capital into physical gold. He understood that the coming crash would trigger deflation at first, but would eventually lead to currency manipulation and inflation. Gold would hold its value when paper assets didn't. When the stock market crash came in 1929, gold held its official price of $20.67 per ounce. But here's the real kicker. In 1934, when President Roosevelt devalued the dollar by revaluing gold from $20 to $35 an ounce, anyone holding gold saw a 69% gain literally overnight. Bernard Baruch's gold holdings soared in value while stocks just kept tanking. By the mid-1930s, he was even wealthier than he was before the crash. The 1987 crash was different. It recovered much faster. But the investors who had bought gold in 1986 and early 1987 still made a killing. Gold was around $300 an ounce in early 87. During the October crash, it spiked to $475. That's a 58% gain in just a few weeks. The legendary investor Paul Tudor Jones held gold positions right alongside his cash. It worked like a charm. Then came 2008. This is where the second trade became absolutely essential. Gold was trading around $600 an ounce in 2007 when the smart money started getting in. As the financial crisis unfolded, as banks failed and the Federal Reserve fired up the printing presses, gold surged. By March 2008, It hit $1,000 by 2009. It was over $1,200. It eventually peaked at $1,900 in 2011. John Paulson, after making billions shorting mortgages, deployed massive amounts of capital into gold. He understood that the Fed's response would be unlimited money printing. And what does money printing mean? Currency devaluation. His gold fund made billions on top of his mortgage short gains. Investors who held gold from 2007 through 2011 tripled their money while stocks went absolutely nowhere. Now, let's fast forward to today. Central banks all over the world have been buying gold at record rates in 2022, 2023, and 2024. They bought over 3,000 tons of gold. That's the highest three-year total since they started keeping records in 1950. China's buying. Russia's buying. India, Turkey, Poland, Singapore, they're all aggressively accumulating gold. They're diversifying away from the dollar. They see what the smart money sees: unsustainable U.S. debt, inevitable currency devaluation. In a fragile system, gold is their insurance policy. And it's not just central banks. Billionaire investors are loading up. Ray Dalio has publicly advocated for holding 5 to 10% of your portfolio in gold. Stanley Druckenmiller has disclosed significant gold positions. Paul Tudor Jones has said he owns gold. As a hedge against inflation and currency debasement, gold is currently trading around record highs. Why? Because the second trade is happening right now. The smart money has already converted to cash in the first trade. Now, they're converting a portion of that cash to gold for wealth preservation. When the next crash comes, when the Fed responds with unlimited liquidity, when the dollar devalues by 20 or 30%, gold will surge to $5,000, $6,000, maybe even $10,000 an ounce. The investors holding gold will preserve their purchasing power while everyone else holding dollars or dollar-denominated bonds gets destroyed. Trade 2 is active, and gold accumulation is happening on an unprecedented scale. So, the first trade protects you, the second trade preserves your wealth, but the third trade is what makes you rich. This is the move that separates the cautious from the legendary. It requires instruments that pay off when markets collapse. It requires conviction. And it requires being willing to pay premiums for months, sometimes even years, while everyone else thinks you're completely insane. Back in 1929, after Joseph Kennedy moved to cash and Baruch moved into gold, the next step was to profit from the inevitable decline. The instrument they used was shorting stocks. Kennedy established short positions across multiple stocks through the late summer and early fall. Shorting means you borrow shares, sell them at their current price, and hope to buy them back cheaper later. Kennedy was paying borrowing costs while stocks were still climbing in September. But he knew the trade. When the crash hit in October, stocks fell 30% in days, 50% within weeks. Kennedy covered his shorts, buying back the shares at collapsed prices and returning them to the lender. The difference was pure profit. Estimates suggest he made somewhere between $15 to $50 million in today's money. That's several $100 million. Trade 3 paid off spectacularly. Paul Tudor Jones's third trade in 1987 is the stuff of legend, and we know the details because a documentary crew was actually filming him during this period. After raising cash and buying gold, Jones bought massive positions and put options on stock index futures. Put options give you the right to sell at a predetermined price. If you buy puts with a strike price of $2,500 when the market's at $2,700, and the market then crashes to $2,000, your puts are worth 500 points of profit for every contract. Jones's execution was flawless, and he reportedly made $100 million in a single day. This is the power of the third trade. Jones bought thousands of contracts. He spent millions on premiums, and he waited. October 19th, 1987. The Dow fell 508 points, 22.6%. It was the largest single-day percentage decline in history. Jones's put options exploded in value. He made $100 million. That day, his phone was up 62% in October alone. A documentary actually captured him on the phone, executing trades and making millions in real time. It's the most perfect example of what's called Trade 3 ever filmed. You pay a premium while you wait, and then you collect massive profits when volatility spikes. Then came 2008. Michael Burry and John Paulson's version of Trade 3 is now famous from the movie The Big Short. But let me give you the mechanics, because this is critical. Burry couldn't short subprime mortgages directly. Those instruments just didn't exist. So he worked with Goldman Sachs and other banks to create credit default swaps on mortgage bonds These are basically insurance contracts. Burry paid premiums about 2.24% per year on the amount he was insuring. If he bought $100 million in insurance, he paid $2.24 million a year. If the bonds didn't default, he lost the premium. But if they did, he collected the full insured amount. From 2005 through 2007, Burry paid these premiums. His investors were furious. They thought he'd lost his mind because the housing market just kept rising. He was losing money every single month. But Burry understood trade 3. In 2007, subprime default started to rise. By early 2008, the bonds Burry had insured began to default. The credit default swaps paid out. Contracts Burry bought for a few million in premiums paid out hundreds of millions when the bonds went to zero. His fund made over $700 million. John Paulson executed the same trade, but on a much larger scale. His funds bought tens of billions in credit default swaps. When the housing market collapsed, Paulson collected $15 billion in payouts, $20 billion across all his funds. He personally made $4 billion. This is trade 3 at its maximum scale. Years of paying premiums, followed by the biggest payout in hedge fund history. Now, let's talk about 2025. Trade 3 is happening right now. The instruments are credit default swaps on commercial mortgage-backed securities, put options on stocks, and VIX call options. The cost to insure against defaults in commercial mortgages has spiked 300 to 500% since 2021. Why? Because sophisticated investors believe commercial real estate is going to collapse. Office buildings are sitting 40 to 50% vacant thanks to permanent remote work. Mortgages that are maturing at a 3% interest rate now have to be refinanced. At 8%, the math just doesn't work. Defaults are inevitable. The investors buying these credit default swaps are paying high premiums now. But when the defaults cascade through 2025 and 2026, these swaps will pay out massively, just like the subprime swaps did in 2008. We're also seeing unusual activity in put options on major indices like the S&P 500. Large institutions are buying put options that expire in late 2025 and 2026. These are bets that the markets will crash during that time. The put-call ratio, which measures the volume of puts relative to calls, has been consistently high. More puts than calls are being bought, which indicates that institutions are hedging. They're buying insurance. They're executing trade. 3. VIX call options are another signal. The VIX measures market volatility, and it spikes during crashes. Buying VIX calls is betting that volatility will explode. And guess what? There have been large purchases of VIX calls, expiring throughout 2025. Bill Ackman even publicly discussed that he is considering hedges, similar to his March 2020 trade, when he turned $27 million into $2.6 billion in just weeks. He hasn't disclosed his exact positions, but he's signaling that trade 3 is active. The pattern is undeniable. Across 1929, 1987, 2008, and now leading into 2025. The same 3 trades happen in sequence. First, convert to cash 12 to 18 months before. Second, accumulate gold for wealth preservation. And third, buy volatility instruments that pay out when markets crash. These aren't random strategies. They're mechanical responses to the same setup. Extreme valuations, excessive leverage, and an inevitable trigger that forces liquidation and creates panic. The investors who recognize this pattern execute the same 3 trades every single time. Let me show you why these 3 trades work by explaining the anatomy of a crash. Every major crash follows the same sequence. It starts with a bubble, where asset prices rise to levels completely disconnected from reality. In 1929, stocks traded at absurd multiples. In 1987, valuations were stretched and margin debt was high. In 2008, housing prices doubled in 5 years because of fraudulent lending. And in 2025, the Buffett indicator is at 185%. Stocks are valued at almost twice the GDP. These are historic extremes. The second stage is euphoria. Everyone believes prices will keep rising forever. In 1929, people got stock tips from shoeshine boys. In 1987, program trading was seen as the secret to endless gains. In 2008, everyone believed housing prices would never fall nationally. And in 2025, artificial intelligence is the narrative. AI will change everything. Valuations don't matter. Just buy. The third stage is maximum leverage. When prices are rising, leverage amplifies gains. So everyone borrows to buy more. In 1929, We saw 90% margin debt in 1987. Portfolio insurance created synthetic leverage in 2008. Subprime mortgages and derivatives created 50-to-1 leverage in the financial system. And now, in 2025, margin debt is near record highs. The fourth stage is the trigger. Something causes a small decline. In 1929, it was a fraud case in London. In 1987, it was rising interest rates. In 2008, it was subprime defaults. For 2025, it could be commercial real estate defaults, a geopolitical shock, or a major tech company collapsing. The specific trigger doesn't actually matter. What matters is that this trigger starts stage 5. Stage 5 is forced liquidation. When leveraged investors face losses, they get margin calls. They are forced to sell. That selling drives prices lower, which triggers more margin calls and more forced selling. This creates a cascade, a death spiral. Prices fall not because of fundamentals, but because of mechanical, forced selling. This is why crashes happen so fast. It's not gradual, it's a liquidation wave. Then comes stage 6, panic. Fear takes over. Everyone sells. It doesn't matter what they own, they just want out. Liquidity disappears. Bids vanish. Prices gap down violently. The VIX spikes to 50, 60, even 70. Markets can fall 20, 30, 40% in just a few weeks. This is the crash. And this is when the 3 trades pay off. Trade 1, cash, means you're not being liquidated. You're not forced to sell at the bottom. You're protected. Trade 2, gold, means you're not holding depreciating cash when the central banks start printing money to bail out the system. You're preserving your wealth. And trade 3, volatility instruments, means you're actually profiting from the crash itself. Your puts, your VIX calls, they explode in value when everyone else is losing everything. These 3 trades address every single phase of the crash sequence, and that's why they work every single time. So, where are we now in 2025? We're in the late stage positioning phase. Trade 1 is substantially complete. The smart money has already raised record amounts of cash. Buffett's got over $300 billion. Insider selling is at levels we haven't seen since 2007. They're out. Trade 2 is accelerating. Central banks have bought 3,000 tons of gold in 3 years. Gold is at record highs. The wealth preservation trade is happening right now, and trade 3 is being established. We're seeing credit default swaps on commercial real estate spiking in price. Institutions are buying put options. The volatility bets are being placed. The fact that these 3 trades are active means we are likely 12 to 18 months away from the crash, based on historical patterns. The crash could arrive in late 2025 or 2026. It could be sooner if a trigger event speeds things up, or slightly later if the market stays irrational. But the window is clear. Within 18 months, the crash is coming, and when it comes, when the S&P falls from its highs, when commercial real estate collapses, when regional banks fail, and unemployment spikes, those 3 trades will pay off. The investors in cash will have capital to deploy at the bottom. Those holding gold will have preserved their purchasing power. And the investors who bought volatility will collect massive payouts. And then comes the implicit 4th trade, after the first 3 trades pay off. After you've preserved capital and profit from the crash, you deploy everything at the point of maximum fear. You buy stocks when they're down 50%. You buy real estate when it's being foreclosed. You buy businesses when they're being liquidated. This is what the Kennedys did after 1929. This is what Buffett did in 2008. This is what creates generational wealth. But you can only execute that 4th trade if you've successfully executed trades 1, 2, and 3 first. Most people can't execute this pattern perfectly. They don't have hundreds of millions in capital or access to institutional-grade credit default swaps, but just understanding this pattern gives you an enormous advantage. You can execute simplified versions of the 3 key trades. Trade 1, raise cash. If you're currently 60 to 70% invested in stocks, consider reducing that to 40%. Hold the difference in cash or short-term treasury bills. Yes, you might miss some gains if markets keep rising, but when the crash comes, you'll have 30% of your portfolio protected. And that 30% becomes your buying power right at the bottom. Trade 2, buy gold. Put 5 to 10% of your portfolio in physical gold or gold ETFs. I'm not talking about gold mining stocks. I mean physical gold, with allocated storage if possible. When a crash comes and the Fed starts printing unlimited money, gold is likely to surge. This helps preserve your purchasing power. Trade 3. Buy protection. You can buy put options on SPY, the S&P 500 ETF. This isn't as complicated as it sounds. You could buy puts expiring in 6 to 12 months with strike prices 10 to 20% below current levels. You might pay 1 to 3% of your portfolio value for this. If the market crashes, those puts could return 5 to 10 times what you paid. If it doesn't, you lose the premium. Think of it like insurance. You pay for protection, hoping you never actually need it. But the most important thing is psychological preparation. When the crash comes, when markets are down 40, 50%, and every headline is predicting the end of capitalism, when unemployment is spiking and banks are failing, you have to be ready to act. You have to have a list of quality companies you want to own. Companies with strong balance sheets, low debt, and products people will always need. Think Apple, Microsoft, Visa, Johnson & Johnson, Procter & Gamble. Quality companies that will survive and thrive. When these companies are on sale at 50% off, you buy with the cash you protected in Trade 1, with the purchasing power you preserved in Trade 2, and with the profits you made in Trade 3. You buy aggressively when everyone else is paralyzed. Buy fear. This is the hardest part. It's not the technical execution of the 3 trades, but having the courage to buy when it feels like the world is ending. That psychological fortitude is what separates the investors who get rich from crashes from those who lose everything. Kennedy had it, Baruch had it, Paul Tudor Jones, Michael Burry, John Paulson, Buffett, Ackman, they all had it. The willingness to act when fear is at its absolute maximum. That's the real secret. So, let me give you a potential timeline based on this pattern. Right now, we could be in the window of 12 to 18 months before a major correction. That would put the crash window somewhere in late 2025 or the first half of 2026. It could be sooner, it could be slightly later, but within that window, the 3 trades are already becoming active for some. Cash is being raised. Gold is being accumulated. Bets on volatility are being placed. The smart money is getting positioned. When a trigger event happens, whether it's commercial real estate defaults cascading, a major bank failing, or a geopolitical crisis erupting, the crash could accelerate quickly. Markets might fall 20 to 30% in weeks, then another 20 to 30% over several months. The bottom will likely arrive when panic is at its peak, maybe mid to late 2026. Unemployment could hit 9 to 10%. The S&P might bottom around 3,500. Bitcoin could fall to 20,000 or even lower. And gold could surge to 5,000 or higher as the Fed prints unlimited money. That bottom, that moment of maximum fear, that's when the 4th trade happens. That's when you deploy all the capital you protected and all the profits you made, and you buy everything of quality at fire sale prices. Then you hold for 5 to 10 years while markets recover, and your positions could triple or quadruple. That's the full pattern. For trades across 18 to 36 months, executed correctly, it has the potential to create generational wealth. Here's the bottom line. These 3 trades aren't a secret. They're not insider information. They're based on a documented historical pattern that tends to repeat. Because crashes often follow the same mechanical sequence: extreme valuations, excessive leverage, a trigger, forced liquidation, and finally, panic. And the investors who see it coming often make 3 key trades. They convert to cash, they buy gold, and they bet on volatility. These trades worked in 1929. They worked in 1987. They worked in 2008. And they're being executed right now by the smartest investors in the world. Warren Buffett is sitting on a massive cash pile. That's trade 1. Central banks are buying tons of gold. That's trade 2. Hedge funds are buying credit default swaps and put options. That's trade 3. The pattern is playing out in real time. The only question is whether you'll recognize it and position yourself accordingly, or whether you'll ignore it and hold through the crash, losing 30 to 50% or more of your wealth. Most people will ignore it. They always do. They'll believe this time is different. They'll say AI changes everything, or that the Fed will save the markets. They'll believe valuations don't matter, and they'll lose a fortune, just like most people did in 1929, 1987, and 2008. But a small group will see the pattern. They'll execute simplified versions of these 3 trades. They'll protect their capital, preserve their wealth, and even profit from the crash, and then they'll buy at the bottom and become wealthier than they ever imagined. The choice is yours. The 3 trades have been made. The pattern is repeating. A major correction is coming. You need to position yourself accordingly. If this video showed you a pattern you've never seen before, If you now understand that the same 3 trades work before every major crash, then subscribe to this channel, because over the next 12 to 18 months, I'll be tracking every signal, every major insider sale, every gold purchase by central banks, every spike in the price of credit default swaps, every single warning sign that the crash is approaching. You'll see the pattern unfold in real time, and you'll know exactly when to execute these 3 trades if you haven't already. Now, this is not financial advice. This is pattern recognition. This pattern has repeated multiple times over the last century, 1929, 1987, 2008, and it's happening again now. The 3 trades are the same. The sequence is the same. The outcome will likely be the same. Position yourself while you still can, because when the crash comes, when it's already happening, it's too late. These trades have to be made before the crash. That's the entire point. And the time before the crash is right now.